Welcome back to my YouTube channel. Today I want to discuss on the IAS 7, the consolidated cash flow. So we are going to tackle this question. So we have been given the following and the consolidated financial statements of Dovu Group for the year ended 30 September 2024. So we have been given the statement financial position for 2 years. Then for the profit or loss, we have been given for the current year. Then from additional information, we have the depreciation at 2400 million. Then we have the carrying amount of 1560. A million of plant was sold for 1720 million. So this means there was a gain. So the gain on disposal was recognized in the operating cost. The property was revalued during the year, resulting in a revaluation gain of 1400 million being recognized. So you have a revaluation gain there. Then also during the year that September 2024, Double Limited acquired 75% of ordinary share from Simba Limited. So here you have acquisition. Then the consideration was 9400 million. The NCI was measured at its fair value of 21.25 million at the date of acquisition. So every time we see the NCI is measured at fair value, we remember that we are going to apply the full goodwill method to calculate our goodwill. So you have the NCI here. Then during the year ended 30 September 2024, DOF also disposed of its entire 80% ordinary shareholding of Kifaru for the cash proceed 5300 million. This subsidiary was not considered as separate unit of operation. Kifaru Limited had been acquired several years ago for cash consideration at 750 million. The NCI of 20% was measured at its fair value of 2 million at acquisition, and a fair value of Kifaru Limited net assets were 46 million at the date. Goodwill had not suffered any impairment. So here the NCI is also measured at fair value. So we shall retrace the full goodwill method. And you have the NCI for Kifaru. At the date of disposal, this was the NCI. So we are asked a consolidated statement of cash flow for Dovu for the year ended that September 2024 using the indirect method in accordance with the International Accounting Standard IAS 7 statement of cash flows. So we are going to do that. So a minute, you can take a screenshot so that will be on to the same level when we are showing this. So let's continue. So I have done this question, but I'll go step by step in order to explain every step that I have introduced. So I will start with the title. So it is Double Group Consolidated Statement of Cash Flow for the year ended 30 September. So we know the IAS 7 requires cash flow to be we have the two methods, the direct and the indirect, but we have been asked to utilize the indirect. So from the indirect, we are going to start with this adjustment as well as the other activities. So we start with the cash flows from operating activities. So the first thing is to check the reported profit before tax. So from our question, we have been told this we are going to obtain it from the P and L statement. It is 6690. So we indicate that. Then we do all the adjustment for that. So if we check in our question, from the profit before tax, we have share of profit of associate, finance cost, gain on disposal of subsidiary, and also in our notes we have depreciation. We are going also to calculate the goodwill for in Simba acquisition, goodwill in disposal, so that we calculate the impairment of the goodwill. so that we can also adjust it on our operating activities. So let me take you one by one. So we have the share of profit of associate. So you don't need to memorize this or clam them. So if you see this is the share of profit of associate here, it is 720. So you are going to subtract it. So the same case, if you see it is an addition here, it has been added, you subtract. If it has been subtracted, you add. So let's continue. So we are going to start with the first. So we are going to less the share of profit of associate. It was added 720 to gain the profit before tax. So we adjust it by subtracting it. Then the finance cost is 700. It is 220. So it had been subtracted. We add the gain on disposal of subsidiary had been added 300. So we subtract. In our note, we have a depreciation of 2400, so that we add impairment of goodwill, so we calculate that. So in our equation 1 or working 1, we are going to calculate the goodwill on acquisition of subsidiary of SIBA Limited. So the consideration paid was 9400. We also been told the NCI share of net assets. It is 2125. So you add that to get 1152. Then you have to less the fair value of net asset at acquisition, which I have been told is 9350. So goodwill on acquisition, we get 2210. And remember that we had been told there was no impairment. Goodwill had not suffered any impairment in Kefaru. We also assume in Simba. So we go to the goodwill on disposal of subsidiary on Kefaru. The consideration paid was that 750. Then we also have the NCI share. The net assets, it was 2000. So we had to get 750. We less the fair value of the net asset. The net asset of Kefaru at acquisition. We always use at acquisition. And the fair value of Kefaru Limited net assets were 4600. So we subtract that. So we get it is 1150. So we open a goodwill account. So we know from our financial position we have also goodwill. So we have the balance brought down and sellers carried down. Since this is an asset, so we start with the balance brought down on the debit as well as balance brought down on the credit side. So we had acquisition. So we have to add that from Simba. Then we also have to subtract this on the disposal side. So we have to subtract that. Then we add. So we get that in 770. That will be our total here. So the balancing figure, or what we shall take to the statement of cash flow, shall be 560. And this is the impairment. So our working here, we should say we add the impairment and the amortization, so they are added as well as the depreciation. So impairment of goodwill, we add the 560. Then we also need to calculate the gain on disposal of plant. The plant was sold from 1560 to 1720. So open that account, gain on disposal of plant. So the balance brought down was 1560. What we sold, the proceed was 1720. So the balancing figure will be on the debit, which is 160. So this is an asset, so it's a gain. So we have that 160. It's a gain, we subtract. So we have to adjust that. So we less the 160. So when we subtract these two, we are going to get the adjusted profit before tax, which is 8640. And also there is one more thing that I'd like to talk about. If you have done this, you can see that the first three, we took them directly from the P&L statement. So there is an acronym here that can guide you to understand more. So we have the dial G. So depreciation, D means depreciation, I impairment, we have the A amortization, loss on disposal of subsidiary or plant, gain on subsidiary or plant. We also have group share from associates or joint venture. Then we also have investment and the financing activity items. We have the investment income, the financing cost. So if you know this, you shall understand that depreciation, the first, can talk about the first 3 or 4. They are added: depreciation, impairment, amortization. In our adjustment, we shall add all of them. The loss, we shall also add either of subsidiary and plant. Any gain, we subtract. Also, all the gains or the group share from associate, we subtract. Then the investment income, we subtract. Finance, we add. So that is what you are supposed to understand that. But so that is the cash flow from operating activities before the working capital changes. So we are going now to calculate the working capital changes. So this involves the three: the inventories, receivables, and the payables. We have the acronyms: the RIP, the receivable, inventories, and the payables. So let me open the account for this. So we have the inventories. We are going to start with the inventories. So as you can see in our question, we have inventories. We have the balancing, brought down, carried down. We also have in our acquisitions, you can see 940. In our disposal, we have this. So you have to know what we are going, or the cash movement. So from our cash movements, we shall use this account of inventory. So this is an asset. So we debit the balance brought down. So it was 2780, carried down 2970. So all acquisitions, we shall put them on this side. So acquisition of Siba Limited, which is 940. We had a disposal of 1030. So we also look at yard. So we are going to get 4,000. So the balance figure is what we are going to take on our statement of cash flow, which is the movement. So since it's on the debit side, this is an increase. So we have said increase in the inventories. So anytime there is an increase, we are going to, this mean, or before I say we are going to add or subtract. So our inventories, we have increased our inventories. What does that mean? So the cash we have given out more cash. So the cash movement is outflow. So if you can look at this, the acronym here, inventories. When we have the arrows means decrease. This side means increase. So we have an increase in inventory, this arrow. So it means cash goes down. So if the cash goes down, we subtract. So we are going to subtract the 200 and 290. I hope we are together up to that point. So we subtract the 280. So that was an increase in inventory. For the account receivable, we are going to open the same. It's an asset. So balance brought down, carried down. We had acquisition as well as disposal. So we have the acquisition, receivable, and disposal of 750. So acquisition on debit and disposal credit. So the balancing figure here, when you add, we are going to get it on the credit. which is a decrease in our account receivable. So we are giving out the account receivables. So we are giving out more money. So what does that say? The cash is going from our acronym. Let me iterate that. So the arrows, you have the decrease, the arrows going up, increase. So we have the arrow which are decreasing, the accounting receivables. So they are decreasing. We are getting more money from our creditors. So it means from our debtors. So it means the cash is going up. So when the cash is going up, we add. So we have the 370. So since the receivables are decreasing, it means the debtors are paying us more. So we add that 370. Okay, let's continue. We have the account payable. So from our account payable, we have the balancing, the two opening and closing, as well as the acquisitions, as well as the disposal. So you open the account. So account payable, these are on the, so this is a liability. So the balance brought down shall be on the credit side, credit carried down shall be on the debit side. So you do that acquisition, you add it on the credit, disposal on the debit. So the balance figure shall be 1020. So what does that mean? I'm going to utilize the same scenario. So in our payable, we have a debit, which will mean the account payable is decreasing. So we are giving out. We are giving out more money, or we are paying our creditors. That's what we mean by the decreasing. So the arrows here mean decreasing, and this one increasing. So we are reducing our loans or from our creditors. So the cash is going down in our side. So if the cash is going down in our side, we are having a cash outflow. So if it's a cash outflow, means we subtract. So the cash outflow subtract. So every time you understand that there is a cash outflow, you subtract. Every time there is a cash inflow, you add. But you have to understand this instead of relying on the acronyms. So those are the key areas that I wanted you to understand that. So we are going to have the decrease in our account receivable as well as decrease in account payable. So the total here is 930. So then you have to subtract the interests paid or the finance cost as well as the tax paid. So the interest, it is same as the finance cost, which is 220, and we shall, before we take 220, we have to go to the current liabilities and check if there was the interest. We have interest here. So do you have the accrued interest? No. So if we had the accrued interest, we would have subtracted here from the interest paid, so that we get the our amount. So you have the interest paid, which is 220. Then the tax paid. The tax paid, we have to calculate the to open the account. So because we have deferred tax, current tax, as well as we have the income tax expense. So tax is a liability. So we open that in our working sheets. Tax is a liability. So we bring down the deferred tax and the current tax, and the two, as well as the carried down on both sides. Then you also have to add the income tax, which was 1400. The income tax here, you can see it was 1400, as well as in our acquisition, you have 250. in our disposal we didn't have. So our acquisition, we also have to add that, which is 250. So in our balancing figure, we are going to get it on the debit side. So this is the tax paid, or what we paid for that entire year. So the cash movement is 1350. So any payment that is an outflow, so we subtract as well as the interest paid. So we get the total. Yeah, we are going to get now it's a positive. So this is a net cash inflow from operating activities. So that is what all you are supposed to do in our cash flow from operating activities. You have to understand that you only need to do the adjustment as well as the working capital changes, and you raise the interest as well as the tax. So let's go to the cash from investing activities. Here you only need to understand that we are dealing with the purchases as well as the disposals, as well as the dividend received. Since we had in our question, we had the share of the share of profit in associates. So we understand that we are going to have dividend received. So we start with the purchases. Let's open that the PPE account, the plant property and equipment account. So this is an asset. So the balancing figure, we bring it here. We had the PPE, we have the balancing, the carrying down. Then we have the opening, closing. We also have the acquisition. We also have to raise the disposal. We also have to raise the depreciation. Remember that this is in the plant and plant. You have to replace, subtract that. We also have to subtract the plant. We also dispose this plant of 1560. So in our account, the opening balance 1050, closing was 1500. So we had the acquisition of 3000. We also had the liberation gain in that question of 1400. So you have to add that liberation gain. Then we have the disposal of that plant of subsidiary as well as depreciation. So when you add, you get 24,390. So our balancing figure, that is the purchases that we made, or the double made, which is 40. So the any purchases that is we paid, so it's an outflow. So it's an outflow from our cash, subtract. So we get 1440. Then the proceed from disposal of plant, it was sold at 1720. So you put the whole amount there, 1720, since it was a disposal. So we also acquired a subsidiary, which is Simba. So you have to calculate the amount paid. So we acquired it as 9400, but there was cash equivalent of 500. As we got a cash equivalent of 500. So we have to raise that. So in our calculation, as you can see here, net cash paid to acquire Simba, the consideration paid was 94. We have to raise the equivalent of cash and cash equivalent. So our net cash paid to acquire Simba was 8900. So we paid 1800. That is an outflow. So we subtract that. Then we disposed Kifalu. Kifalu, we disposed it for 8900. We have been given 89. We'll see that. The cash proceed that we got was 5300, but you can see there is a cash and cash equivalent of 300. So you have to raise that. So our cash consideration proceed we got is 5300. We raised the cash and cash equivalents of 300. So our net cash proceed, what we got from Kifalu, was 5,000. So the proceed from Kifalu, that is 5,000. Then we have said that we have the share of profit of associate. So if you see this, you remember, you understand that there have been some investment. So, and in our financial position, you can see we had the investment in associate. So you have to open this account so that you can be able to understand the dividend received. So in our dividend received from the associate, the balancing brought down was 33, carried down 38. And they also the share of profit that we have been told here was 720. So you earn that. So the balancing figure or the dividend received, it shall be on the, it's on the credit side. So it is 220 if you subtract this. So you only need to get the balancing, the opening and the closing, as well as you add the share of profit. So that is the received. So there was cash inflow, what we received, that is 220. So in the cash investment, you have said you only discuss on the purchases and disposals, nothing more. So as well as the dividend received, those are the things we discussed there. So how will we look the cash movement from that area? So the when you add, you are going to get a negative 800. So this is a cash outflow. So the net cash outflow from investing activities was negative 800. I hope we are together up to that point. So let's continue to the cash flow from financing activity. This one involves equity and NCL, or the non-current liabilities. So that is all what you are supposed to look, the equity side as well as the current liability. And we have checked, we have done the deferred tax. So you are going on to check on the bank loans as well as the equity, as well as the the equity and the non-current. So from the equity, we have the ordinary, we have the share premium, the valuation that we are not going to do. Retained earnings, this is the dividend. So we are going to calculate the dividend paid to parent, by parent, and to NCI, also the non-controlling interest here. So let's start. So the issue of new ordinary shares, as you can see, so the opening is 8,000, while the current the closing is 10,000. So cash movement here shall be 2,000. So this is the statement we are going to put in the cash flow, the movement of that, which is 2,000. For the share premium, the same case, opening, closing. So the balancing or the movement of cash is 300. So in our working issue of new ordinary shares, we issued 2,000 as we have seen. For the share premium, we have seen is 300. We add that. We have seen the revaluation that is not on the, it's not a financing. So retained, here is where we are going now to calculate the dividend. So our retained earning, it will help us to calculate the dividend paid by the parent as well as paid to the NCI. So let's start. So dividend paid to the parent, we have the opening, closing. We also look at the profit of the year, attributable to the group owners. We also have that. So those are the three things we need to check. The retained earnings as well as for the group. For the dividend paid to the NCI, we shall look at the retained earnings as well for the NCI, as well as the profit attributable to NCI and the comprehensive income. So for the parent, the balancing or the opening, We have this as an income, so that's why we are starting on this side. So 67, 80, the closing we have 10,000. Then we add the statement attributable to parent, which is 4690. So the balancing figure here is the dividend paid, which is 1380. Since it is paid, that is an outflow. So outflow is subtract. So 13 and 1380. For the NCI, we bring the NCI account. So the dividend paid to NCI account. So we started with the opening was 2000, as you can see here. 2000 closing. Then we also have the OCI, and also you have the NCIs here in the acquisition. You have to get note of that. You also have NCI here of 2000 million, as well as the disposal. We have to calculate the shares of 20%. So what we do, we start with the opening and the closing for the NCI. Then we have the acquisition. We got the acquisition to be 21. The NCI measured at fair value was 21.25. Disposal, that is another calculation. So NCI fair value at acquisition was 2000 at Kipari. So the NCI that we had at acquisition was 4600, the net assets, but as we dispose it, it was 6100. So you have to less this and multiply by 20%, so that we get the amount or the net of NCI disposed during that time. So 20% of 61 minus 4600, we get 300. So 300 we earned from the NCI during acquisition, which was 2000. So we are going to get 2300. So this is what we call in our NCI of disposal. So we disposed the subsidiary, which is 2300. So, and you also have to earn the income or the comprehensive income. I have been told attributed to the non-controlling interest of 600, as well as the profit attributed to non-controlling interest of 600. So it means here they are same. So the OCI, the non-controlling interest, had no comprehensive income, but we shall add so the profits. So it was 0. That's why they are the same. So we add to get 600. So the share of OCI here 600 from the NCI. So the balancing figure, it's what we are going to get the dividends paid, which is 485. So that is an outflow. We less. We said that we need to look on for in our investing activity. We need to look at equity and non-controlling liability, as well as the dividend paid. Dividend paid. So in our we have calculated the equity dividend paid. Now we are going to look at the long term or the non-current liability. So in our non-current liability, dividend tax we calculated. So you only have the back loans, which are the long-term liabilities. So since it's a liability, we credit. So our opening shall be the credit, closing debit, the balancing figure. That is the we shall take it on the statement of cash flow. So the statement of P&L, or let's say cash flow here. So we get that statement of cash flow, which is 600, or the balancing figure, which is 625. So since it's on the credits, meaning we are getting more cash from our long term. We have taken a more loan, so we add that. So when you subtract this and addition, net cash flow, it's a net inflow. So our net cash inflow is 1060. So the next thing you do is you add all of them, the three of them. So the cash and cash equivalent during the year will give us 435. Then we add the opening cash and cash equivalent, so that we are given. So we are cash and cash equivalent here, we are given 875. So when we add both, we should get the closing inventory for this year, which should be 10. So we add cash equivalent opening, which is 875. So the two, I have added them. So these two are giving us 1310. So 1310 is our closing. So it means we are correct. So this is what we are supposed to do from this question. So I have given you some hints, some acronym here, so that you can be able to understand as we go on. So any recap here is remember the dial G, the leap, as well as the in our equity we have these two, the financing. Remember the purchases and disposal and dividend received. That is what we already did. In our investment we deal with equity and current liability, as well as the equity will give us the dividend paid, because it contains the ordinary shares, share premiums, all that, and as well as retained earnings. So I think that is enough for today. So give any comment, subscriptions, any like, it shall be much appreciated. And also for any query, any additional information pertaining this question, any clarification, as well as I'm open for any corrections. This is not the final answer, but will help you to do your customer exams or any other accounting exam. Thank you.